Are you looking for better returns on your investments while avoiding the ups and downs of listed markets? Private markets, once reserved for institutions or the very wealthy, are opening up to everyday investors. They come with the promise of higher returns, compared with the current best rates available for fixed deposits with guaranteed returns. But the rewards come with real risks. They can tie up your money longer, expose you to more uncertainty, and come with no guarantees. Private market investments are investments in assets that are not traded on public exchanges.
Now you get access into institutional quality deals that were previously only confined to a certain individuals or very high net worth individuals. So you can diversify your capital, reduce the risks, and hopefully achieve better returns for yourself.
Fractional real estate co-investment platforms allow investors to pool capital and own fractional stakes in institutional-grade property deals worldwide.
You could be investing in an office building in Sydney, you could be investing in a data center in Netherlands, you could be investing into a last-mile logistics in the US. Such investments are only for those high net worth who have millions of dollars and only access to private markets, right? So we decided to change all that. Now, we wanted to provide access for everyday investors to gain access to such high quality deals at a smaller quantum sums. For real estate credit deals, the borrower could default, right? So for us, it's important that we underwrite conservatively. Loan to value ratios are kept low, and we want to ensure that the property is well performing. At the end of the day, he can repay you the loan. Right? So for our capital growth products, there are a couple of risks one has to be grappled with. Number one, market risks. Right? There could be shifts in property value, changes in interest rates, and economic slowdowns. This all affects the performance of the asset. In addition, there's also execution risks. Right? Development projects, sometimes there could be delays in construction, changes in the budget. All these does affect the returns as well.
So how does this kind of private market investment stack up against REITs or real estate investment trusts, which are traded on public exchanges?
With the fractional real estate investments, what you are likely trying for is higher capital gains because you're directly getting a stake in the asset, and of course, if there's appreciation of the value, then you can realize much higher capital gains. For REITs, you are less likely to realize such high capital gains, but what you're exchanging that for is a bit more certainty with regards to cash flow and your return, because the REITs distribute dividends from the rent. And of course, if there is some capital gains in the REITs due to changes in how in the NAV, that's also a bonus. But with direct real investing through fractionalization, you're likely taking a more concentrated position. So because you're having maybe one or two assets, or it could be, So if you have less, if you're taking a more concentrated position, your chance for getting a higher return is there, of course, but then you also expose yourself to higher risk, because if that investment doesn't go right, then you have more downside.
Another route into private markets is through peer-to-peer lending or crowdfunding platforms.
These platforms provide business loans, unsecured business loans to SMEs in Singapore. Right? They do not compete with the banks. They are actually complementary to the banks. The investments on the platform, largely it varies across industries, be it F&B, be it construction, be it retail, or any brick and mortar businesses, even for technology companies, as long as they qualify or they pass their underwriting.
Basically, the returns come from the investor making a loan to a company, and the company has to pay interest and then repay the loan. The risk is that these are loans made to companies that are smaller, so obviously there's the chance that your loan does not get paid back. As in all investments, there's a risk, and so the risk here is that the business environment changes, the company might run into some difficulty and they might not be able to service their loans. I mean, the smaller risk is that they might not service it on time, so you get delayed payment. Maybe eventually you get the money back, but there's an opportunity cost there. The bigger risk is, of course, the company is unable to pay back the loan in its entirety, and then you risk loss of capital.
Your returns can also be affected by fees imposed by the platforms.
If you're looking at 1% per month interest, basically you're not getting the full 1%. There are some hidden fees, like the platform fees, the success fee. Take success fee, for example. The platform could be imposing a 20% on the success fee, on 20% success fee on your interest, meaning if you are promised a 1% interest per month, and if the money comes in beautifully as repayment, repaid beautifully, what you're getting could potentially be only 0.8% and not 1%, unless you are saying there is a net return, meaning all fees have been accounted for.
Something else to consider, these investments are very illiquid.
For typical private equity funds, you are locked up for maybe 8 to 10 years. There's the potential of not getting any capital back for a long period of time. Secondly, there's a lot less disclosure. It's a lot more opaque kind of investments, because you don't get a price every day, because these are very long-term investments. So it can be a lot harder for retail to understand the investments.
But access to private markets is being democratized, and new channels could be created for mass retail investors. One recent example is the latest Astria private equity bonds, which were over 3 times oversubscribed.
Given the evolution of financial services and financial markets, there's likely a chance that there'll be more products down the line. I guess it's potentially the case where we see funds that are able to provide some form of liquidity to retail investors, but it would be making investments either in private credit or in private equity, but they are able to have some form of liquidity mechanism that gives retail investors the ability to exit their investments if they need to.